Well, hello everyone. Welcome to the Buffett and Beyond weekly stock analysis video, computer software, and our old friend Adobe. And remember, folks, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And before we go on, just want to let you know that you can get a 2-week free subscription. We just need your name and email, and you get the archives of all our videos, use of the computer program. That's 1,800 stocks, so you could pick your own portfolios, daily letters, all our model portfolios for this year, and the top stocks in all our ETFs that we follow. So, folks, 2 weeks free subscription, need your name, email, and just go to buffettandbeyond.com. Buffett is spelled with 2 F's and 2 T's. Buffett and Beyond is one word. Just sign up and you'll get your 2-week free subscription. Okay, folks, we'll see you there. Oh, yes, and don't forget that over the past 22 years, our compounded returns have almost tripled the S&P 500. That's since 2002, a long time ago. Okay, folks, buffettandbeyond.com, 2-week free subscription. Okay, let's go over Adobe. Develops various computer software products, and you all know them, folks, because you all use it, that enable users to create, transfer, print electronic documents. In fiscal 2022, the company operated in the following primary business segments: digital media, digital experience, and publishing and advertising. Adobe's leading software products include Illustrator, Photoshop, yeah, you all know that one, InDesign, and Acrobat. And R&D spending is about 17% of the revenues, has almost 30,000 employees, so it's a pretty big company. And let us look at the 5-year averages of this company. And Adobe is in green. The vertical lines we're talking about, of course. Adobe is in green, and the blue is the average stock in our entire database. So when we look at the clean surplus ROE, which we'll look at in another slide again, it's doing very, very well, not quite doubling the average stock out there. And with net income, 19.7% versus the average stock of 13%, and revenue, which is very, very important, folks, 16% versus the average stock of 7%. So more than double the average stock out there. And that's how they bring money to the bottom line, is by having that revenue income. And one of the things about Adobe that you should be aware of, but it used to have you sign up for 1 year. And then, 5-6 years ago, it went on to a monthly payment system. So now Adobe has money coming in every month rather than just the once a year payment. So it has a more distributable, a more even cash flow than it did before. And that's just skyrocketed Adobe. It just started going up after that because the market participants love that. And when we look at a closer look at the clean surplus return on equity, we can see that in 2020, yeah, there it is, that is COVID. Remember, all of a sudden the clean surplus return on equity, and think of clean surplus return on equity, a comparable number that we can compare to other systems, because think of your bank account. When you look at a bank and you look at the interest rate, you are looking at a bottom line number. Same with treasury bills and treasury notes and treasury bonds. You are looking at a bottom line income stream. So with clean surplus return on equity, it's common to all companies, and thus we can compare Adobe with Microsoft, with Digital Data Whack, with any other company. And the higher the clean surplus return on equity, think bank account S&P 500, about 13%. Bank account Adobe, well, we're looking in 2020, we were looking at 31%. It shot up, but it was in the 20s for a couple of years, going up. And as you can see right down here, going up, the market likes that because that means the earnings are growing at an increasing rate. In other words, they are accelerating. The problem is that it did so well in 2020 and then 2021, and then it started going down a little bit. But don't forget, the average stock is 13%. The clean surplus return on equity here is almost, 17% for these 2 years in here. And we're looking at the earnings growth Still plenty of growth, but the thing is, it is slowing down a little bit. So the rate of increase, in other words, is slowing down a little bit. And we can look over here, and this is what's happening with most stocks today. And when we look in the computer software stocks, because I look at them all the time, we see this in a lot of those stocks. The growth rate is slowing down. And of course, high interest rates, the economy slowing down because of those high interest rates. Now, retention rate, the company is taking all the money it's making and putting it back into itself in order to grow. We like that. Now, the net income growth rate on 5-year average is higher than the growth rate over the past 4 years. This 80% in 2020, the year of COVID, 80% income growth, of course abnormal, but it is distorting this 19.7% because here's 5 years right here. And so this 80% is distorting it. But the income growth rate is rising now, and the market likes that. The revenue growth is twice as good as, or twice as high as, the average stock out there. And for 2024, it's back up there again. Remember, the average growth rate, revenue growth rate for the average stock is 7%. So we're looking at 14% projected for next year. So these numbers are going up, and that's why the stock is doing so well. So let's look at the 1 year. The black line is the S&P 500, up about 12% after our latest correction in here. And this stock is up, 47, 48%. So it's up almost 5 times the average stock in the S&P 500. Now, don't forget, 96% of professional money managers cannot outperform the S&P 500 over any 10-year period. And when we say professional money managers, we're talking about the managers of the publicly traded mutual funds, because we can follow them on a daily basis. Now, over 5 years, we can see, black line again, the S&P 500, we can see this stock is up about 112%, with the market up about 50-some percent, 57, 58%. So it's almost doubling the S&P 500. But look at this. This whole area in here is 2022. And the market was down, black line, down about 19.6, well, not about, down exactly 19.6%. But look at the fall that Adobe took. But look how far ahead of the S&P it was. So it went down more than we expected it to. And let's look at that again, just the price. So this is just Adobe now. It went from a high of 700 right up in here all the way down below 300. So this is like a 60% decline, folks. That was a nasty, nasty decline. And now it's climbing back, and you can see this rate of ascent in here. And this is 2023. And you can see that it was playing around back in here a little while, and then all of a sudden the numbers came out on this stock, and it looks beautiful. So with earnings season pretty much behind us right now for the second quarter, this stock did very, very well in the second quarter. So we like Adobe. It's in our growth portfolio, doing very, very nicely. And the question is, will we keep it in our portfolio for 2024? And we will look at other stocks in the computer software business, because don't forget, you got friends like Microsoft in that area, Paycom. So we see a lot of computer software companies that are very, very good in there. So we are looking at the computer software business, and we are looking at it very, very closely, and we'll have further stocks on it, folks. So, folks, we're having a pretty good year so far with the growth portfolio up almost 40%, and we'll see what the rest of the year brings us, because here we go into autumn. And yes, this is the beach. So if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Okay, folks, you stay safe, and we'll see you back here next time.